Okay, so we're going to be talking today about creating multiple streams of income using property. Now, the reason why that's important is because the future of work is going to be very different than what it looks like now. The future of work is going to be very much remote-based work. People aren't necessarily going to be working in offices. I mean, some jobs obviously will have to be office-based, but many jobs won't be office-based. They'll be able to work from sandy beaches of Thailand, and we need to be able to accommodate for that. I don't believe that there are going to be full-time permanent contracts in the future, except again, barring certain jobs. But mostly it's going to be a project per project basis. And we're all going to become more consultative in our approach. So we're going to consult a company for 6 months on a certain project and then consult our services out to another company, which means we're going to start working on a project by project basis, which then leads me to my third concern about the future of work, is that we're going to have to create multiple streams of income to survive. With the reduction of permanent employees and the rise of remote, contractual, consultative-based work, creating multiple streams of income to protect ourselves and to create that financial abundance is really, really important. So, what is financial freedom? As you can see, my dude on the top left there, he's enjoying a nice, looks like a strawberry daiquiri while sitting on the beach, and there's money flowing in. Now, that is what we call passive income. You can see he's not working, but money is still coming in. Once your passive income equals or exceeds your monthly expenses, then you are considered financially free, meaning that you can live off your passive income. You don't need to work to pay your medical bills, your transport costs, your entertainment costs, etc. And today we're going to unpack how you can create a path to financial freedom. Now, there are many different ways in which you can create passive income. Property is not just the only way. For example, these are the three systems or approaches that I use. The one being obviously property. The middle one is online business. I'm very involved in certain online businesses, which brings in a passive income. And then writing, my book is now live and it's generating royalties for me without me having to actively put time into it. So let's discuss a little bit more in detail how you can create a plan for you to reach financial freedom in property. Now, we're going to look at one of the strategies in property being the passive strategy or the cash flow strategy. This is anything related to earning a recurring income from a transaction. This is when you buy a property, put a tenant in there, the tenant pays you rent every single month. Whether you work or not, you're getting paid that steady income stream. And we're going to focus on three strategies today, being buy-to-let, multi-let, and then a very, very exciting, quite an advanced strategy known as rent-to-rent. Now, if you don't know what rent-to-rent is, it's essentially investing in property with zero cash. And I'm leaving that until the end of the webinar just to keep you engaged and excited until the very end. Okay, so let's talk about making a plan to reach financial freedom in under 5 years. Now, if you do have a calculator on your computer or you have a pen and a notepad next to you, please grab it quickly because we're going to make this a bit of an interactive workshop. Firstly, step number one, to determine what your financial freedom plan is, what are your current monthly expenses today? So if you have that calculator, or maybe you have a budget template on your computer and you already know what you're spending, or maybe you can just thumbsuck more or less a rough number. What is it that you need coming in on a monthly basis to survive? Let's assume, for example, that you lost your job tomorrow. How much money would you need to have coming in from, let's say, property or whatever income stream you're working with to be able to survive? Okay, that's step number one. I'm going to use an example of 20,000 just so that we can, do the sums together. Now you need to determine what that value is going to be in 5 years' time. That's very important because with inflation and with the currencies, slowly devaluing, money today is not going to be worth money in 5 years' time. Right. So your 20,000 Rand that you need today won't be sufficient in 5 years' time because water becomes more expensive, petrol, electricity, all of these things go up in value. So using the assumption of inflation, which is 6.5, you can do the first sum there on the top, which is your amount, your monthly expenses times 1.065 to the square root of 5. Or alternatively, you can do the second calculation, which is 20,000 times 1.37. So whatever your current monthly expenses are today, times that figure by 1.37, and you will know what your passive income goal is in 5 years' time. And if you reach that, you should technically be financially free. So if I do this example, my number would be then 27,500. Okay, now everybody's number is going to be slightly different. The final step that we have to take is to determine, is this a feasible and achievable goal? Right, we're going to go now to the next level of detail to see, is this something that you can possibly achieve? So the feasibility comes down to three factors: the number of deals that you need to do to reach this goal, the financing to be able to do those deals, and then the time available to do the deals. If, for example, your goal is to maybe make 100,000 Rand in 5 years' time, but you've got zero financing, you don't have a job at the moment, and you're struggling with time, it's maybe not a feasible goal. Maybe we have to push your financial freedom dreams to 10, 15, or 20 years' time. The point is not getting there quickly. The point is getting there eventually. Because this isn't a race, it's about getting out of the rat race. So I've just used the metric of 5 years so that we could put something in stone, or give ourselves some sort of timeline. But you can be working on anything between 2 to 20 years. It's not a race. It's just about getting yourself financially stable. Okay, now before we go a little bit further, I just need to explain the principle known as cash flow in property. Now, cash flow is essentially income minus expenses, whatever you're left over with, which is your monthly profit. So here's an example of a deal. The asking price of this property, it's a 2-bedroom, 1-bathroom flat in an estate. The asking price is 850. Purchased it for 645. The rental is 10,000 per month. Bond repayments, levies, they're all your expenses, and you're left with a monthly profit of 1,500 Rand. That is what we in the property game deem as cash flow. Okay, so that's just something you need to remember, because I'm going to be talking a lot about cash flow now. Cash flow is basically your rental minus all of your expenses, whatever you're left with at the end of the month. That's your monthly profit or your monthly cash flow. Okay, so now we need to choose a strategy that's going to help us achieve that goal that we've set ourselves. Now, from my experience in investing in property and helping people become financially free through property, you've essentially got two main strategies. You've got your buy-to-let, which is on the left, and you've got your multi-let, which is on the right. Your buy-to-let is when you have one house, one tenant. So you buy a 2-bedroom flat and a couple moves in there and they pay you your rent. A multi-let, which is on the right-hand side, is when you have one property or one block and you have multiple tenants. Now, what you'll see there on the top is I've put the average cash flow that one can expect to receive from these different strategies. When you're following on the buy-to-let strategy, you'll see your cash flow usually hovers around the 1,000 Rand mark. When you're looking at your multi-let strategy, you're looking at between 5,000 to 6,000 Rand positive cash flow at the end of the month. Okay, so just knowing those two figures, we can now determine exactly how many properties you need to buy to reach your goal of financial freedom. Okay, so the plan, you're going to take whatever it is that your goal is in 5 years' time, and you're going to divide it by 1,000 Rand, and that's going to tell you how many buy-to-let properties you need to purchase to reach freedom. So in my example of wanting 27,000 Rand per month passive income, I'm going to have to buy 27 buy-to-lets, which are each bringing me 1,000 Rand on a monthly basis in terms of profit. All right, so in year 1, I'll buy 6 properties. Year 2, 6, 6, 6, and in my final year, I'll buy 3 properties. And that would essentially be my goal, my plan. I need to make sure that at every 2.5 months, I'm purchasing a buy-to-let property, adding it to my portfolio, and I can realistically retire in 5 years' time. Now, you might be looking at that and saying, okay, Lawrence, but I can't buy 27 properties in 5 years. And I agree with you. That's maybe a bit of an aggressive goal. That's then where we have to say, is this more a 10-year plan or a 15-year plan? It's not a race. It's not about getting there quickly. It's about getting there indefinitely. If we look at the multi-let route, to get the same kind of results, we're going to have to buy 5 multi-lets, which is 1 per year. And that is probably the biggest reason why I like the multi-let model, is because you're getting a lot more bang for your buck. You're getting a lot more return and a lot more leverage for the income. Now, if we look at, again, making this feasible, these are the number of properties you need to buy. Will you have the time to do this? Will you be able to do this number of deals in a year? And number 3, will you be able to access the financing? This is critical. Now, if we're looking at the buy-to-let model, most properties where you're going to get 1,000 Rand cash flow, you're going to have to buy lower income properties. So let me use an example like an area like Berea or Blaubossrand. You're looking at buying a property for about 200 to 250,000 Rand, where the rental is 5,000 Rand or more. Now, in order to purchase a property for 200 to 250,000 Rand, you're going to have to put certain costs down. You're going to have to pay like deposits and transfer costs, etc. And these fees are going to be probably working out to about 30,000 Rand per deal. The rest of the money you'll probably be able to loan from the bank. So you'll get a 90% loan from the bank. The remainder of the deposit you'll have to put down, and the transfer fees, that's why I'm assuming around 30,000 Rand that you're going to have to put down per deal. So 30,000 times the 27 that you need to purchase means you need to access 810,000 Rand of your own money over the next 5 years to be able to build this portfolio. You might have a big enough income, you might have a big enough salary to save that amount of money, or perhaps you're going to have to access some private money and work with private investors. So over the 5-year journey, the 810,000 means you're going to have to invest 162,000 Rand per year into your business. The rest of the money you can leverage from a bank. That is the money, your own money needed in the deal. If we look at the multi-let model, it's usually about 250,000 Rand that you need to invest on a deal per deal basis. So that's just to give you a bit of a sense as to what your commitment needs to be on a monthly basis or on a per deal basis. So I hope that makes sense. So let's talk a little bit more about financing, because that's obviously where a lot of people do get stuck and a little bit frustrated because, not everybody's got the access to capital. So when looking at getting finance for your property portfolio, you're going to have to look at 3 things, which are the same 3 things that the banks look at when thinking about giving you money. The first one is affordability. So whatever your salary is, usually what the banks will do is they'll take a third of that salary and they'll say that can be used to pay off the bond, and that's how they justify giving you a loan. So if your salary is, for example, 30,000 Rand, the bank will say a third of that is 10,000 Rand, which means on a monthly basis you would be able to afford to pay 10,000 Rand per month, which means they will give you a loan of roughly 1 million Rand. Right? So that's a nice quick way in which you can determine what is your current affordability and what do the banks consider giving you in terms of a loan, taking a third of your salary. The second very key important aspect is credit score. Doesn't matter how good your affordability is, if you've got a bad credit card debt with Woolworths or Edgar's and they've blacklisted you, until you've resolved that, there's no way you're going to get a loan from the bank. And then finally, the deal. The deal needs to make financial sense. And what we're going to do in a couple of minutes' time is we're going to do some live deal analysis together so we can see how do we make sure a deal does make financial sense. So starting with affordability. Now, this is where sometimes people get stuck with property investing. If I look at an area like Fourways, which is in Johannesburg North, it's a high-income area. It's a place where a lot of people like to stay. It's modern. It's suburban. It's a great place. And a lot of people think it's a good investment area because, well, people want to live there and it's growing in property value. But if you look at it from a cash flow point of view, this is the reality of how the deal will work. Your average purchase price is about 850,000, with your rental being 9,500. Your monthly expenses are 12,000 because you've got your bond, then you've got levies, rates and taxes, water and electricity, insurance, maintenance. All of that added up means that you're going to be losing 3,300 Rand per month on your property portfolio. Now, what happens is the banks, they take your salary minus the 3,300, and then they decide whether they're going to give you a loan. So this is decreasing your affordability. So you can only buy 2, 3, maybe 4 properties in Fourways until eventually the bank says, okay, your affordability is used up. Where if you follow a different approach, for example, investing in Berea, which is a highly dense, low-income area in the center of Johannesburg, this is how the numbers turn out. You're buying it for 200,000, your rent is 6,000, and your expenses all inclusive, the same as in Fourways, except you're walking away with 950 Rand per month positive cash flow, which then the banks add to your salary. Now, if you keep buying properties in Berea, you eventually add so much money to your salary that your affordability goes up so that you can continue accessing capital from the bank. So what I'm trying to show you here is that the investments are not necessarily in the high income, nice, luxurious suburban areas. They're in the lower income areas where the demand for housing is so high that people tend to pay a little bit higher for rent, and the property purchase prices or the market values haven't risen as quickly as the rental has risen. The Berea investments, that's where you're going to continually add to your affordability to access more and more capital from the bank. When we're looking at credit score, I'd like you to write this down, clearscore.com. That is one of the tools that I use to be able to see what my credit score is. It's a free tool, gives you a monthly report. There are plenty of different tools out there that you can use. I just use ClearScore and it's worked for me, so that's why I'm recommending it. But make sure you go and check out what your credit score is. Maybe you've got, a silly bad debt with Woolworths that you just forgot about, and they've, blacklisted you, and that's going to affect your ability to get a loan from the bank. Go check it out and make sure that you clear all your bad defaults. Make sure that you get your credit score up to speed, because that is what's going to get you the attention of the banks and get you hopefully the successful bond to start your property business. Lastly, we have to look at deal analysis. So we've looked at how do you create a plan, a path to financial freedom. How many properties do you have to buy, and over how many months or years do you need to buy it? And then we've looked at financing. Is your affordability sufficient? Does your credit make sense? And now finally, we're going to look at deal analysis. Does the deal make financial sense? So before we get into actually analyzing some of the live deals that we have for you tonight, I just want to make sure that we understand what the return on investment calculation looks like. So there are two key aspects of the return on investment calculation, which is basically your decision-making criteria when looking at a property investment. You've got your profit, which is your cash flow times 12 months so that you can get a yearly figure. And then your money in the deal, right? Remember, when you go to the bank will loan you X amount of the property. They'll loan you maybe 90%, which means you have to find the 10% of that figure of the purchase price as a deposit. And then you'll have to pay transfer fees, bond registration fees, renovation costs, holding costs. Anything that is money you have to take out of your pocket is what we call your money in the deal. Okay. So let's use a quick example. Let's say you're investing in this very nice city center. The market price is R1 million. You're able to negotiate it down to 600,000. You're able to get a great discount. The bank is willing to offer you a 90% loan to value at a 10% interest rate. So they're willing to loan you 90% of the 600,000 at a 10% interest rate. Okay. So your buying costs will be the 600,000 times 10%, which is your deposit, plus another 65,000 for transfer fees, bond registration fees, etc. Your refurbishment costs are going to be 80,000, and you're going to hold it for 3 months, which costs you 20,000. So your money in the deal is 225,000 rand. That's how much money you have to take out of your pocket to invest in this deal. Or that's the money you have to loan from an investor regardless. That's the money you need. The rest of the money will be financed by the bank. Okay, let's look at the cash flow statement. Rental of 15, expenses every month. You've got your bond, your levies, your rates and taxes, insurance, and your monthly operating expense, right? You're looking at your cash flow, which is your rental income minus all your expenses. You're left with 4,000 Rand running profit per month, which is great. So now we work out the return on investment. First of all, you take the 4,000 Rand that you're making on a monthly basis, times by 12 to get an annualized view of your profit. You divide it by your capital invested, times by 100, and you've got your return on investment of 21.33%. That's what you can then compare to the banks. If the bank is giving you a 6, 7, or 8% interest rate, and this property is giving you a 21% return on investment, essentially that would be justification enough for me to say, I'm going to take my money out of the bank, I'm going to put it in this property, and although the property's got a bit of risk, I know that the return or the reward is worth the risk that I'm taking. Does that make sense? So I hope that we're all on the same page in terms of what this return on investment calculation is all about. Now we're going to get to the very exciting part of this workshop. We're going to analyze 4 deals together. So our first deal is going to be with a guy by the name of Tyron. So what I'm going to do is I'm going to invite Tyron onto the screen with us so that he can talk us through what this deal is all about. and then we're going to analyze it together. So Tyron, I've just sent you an invitation to join. I think it's pretty easy to join. I hope that it makes sense when you get on there. Just let us know if you are winning. So Tyron, can you hear us? Hello, hello, hello. It says he's accepted and he's connecting. While we're waiting for him to connect, I'm just going to talk you through the deal. So it is a Blobos Runt deal, which is in the Johannesburg North area. It's a low income area, which means it could potentially work for cash flow. The asking price is 315,000. Tyron's assumed that if he can purchase it at 260,000 Rand, he could make 1,000 Rand cash flow, which is exactly what we want to be working on. Okay, so I can see Tyron is trying to connect. Tyron, can you hear me? Sorry, guys, he's trying to connect here, and I see he's struggling. So what I'm going to do is I'm going to share my screen, and I'm going to take us through the deal analysis so long. And then as and when Tyron can join, I'm sure he will. Okay, so I'm assuming you can see my screen here. I'm logging into my property app, which is the tool that we use when analyzing property investments. I'm going to go here to analyze a deal. I'm going to go to analyze a buy to let, and I'm going to add a new deal, which is Tyron's deal. So we're going to go through the steps together. We're going to analyze the deal together and take it from there.
Hello?
Yes, there we go. Are you there, sir?
Okay. There's a bit of trouble.
Fantastic. Tyron, do you want to tell us a little bit about the deal?
So I had a quick look I was looking at lower income areas, so like Berea, and then I saw Blobos Runt, and I saw a couple deals going for around 300,000, and the average rentals, I contacted the estate agents, and they were saying around 5,500 on a monthly basis. So, I mean, I had a look at these deals, and some of the properties there was 3 properties in the same complex, and most of them had been reduced to about 290. So I did make an assumption that I could get it for 260.
Okay, so asking price 315, offer price of 260. So you're asking for about a 17.5% discount, which is good. Anything between sort of 10 to 20% is good. And you said the rental is?
He said it's about 5,500 a month.
5,500. Okay, cool. I'm going to then quickly, yeah.
So I did look on TPN, and it was 8,000 to 9,000, but that seemed very high. So I went with what the estate agent said.
Okay, well, let's add here TPN is about 8,000 Rand, and we get an average of about 6.5. Let's maybe add one more. We'll make it here 5,250. Let's work on 6,250. I think that's a fair one to look at. Okay, I'm going to just open up here a Uber calculator, which helps us work out what our transfer costs are. So Tyron said that he's purchasing it for 260. Loan, would you be loaning on this property?
Yeah, I said a 90% loan.
90%. So I'm going to go with 240 as a loan. It is a freehold. That's a no. And you're going to buy it as a natural person or in a company?
Natural person.
Natural person. So you could calculate here, and it'll tell us that his transfer costs will be about 26,000. Okay. So I'm going to go here to buying costs, and I'm going to add here 26,000. Do you expect any renovation costs on this one?
It did look a bit downgraded, so yes, I just made an assumption of 20,000 for paints and up.
Okay, let's go 20,000. Let me actually just have a look here. I know you sent me the deal. Did you send me a link? I can't remember if you sent me a link.
It's in the Word document, yeah.
It's in the Word document. Okay, so I'm just opening up the Word document so we can have a quick look at what the pictures look like, and then we can make an assumption regarding refurbishments. Okay. So I already like this one because you can see it's relatively well maintained, and it looks like it's currently lived in, which is good. Okay, awesome. And I can see here you've pulled the TPN report as well, so we can see if it's a high risk or low risk area. That's great. Okay, cool. Let's go to finance costs. So you said you're going to do a 90% loan to value. The interest rate that you're receiving?
7.75.
Now, if you're a little bit shocked by that, ladies and gentlemen, it's because Tyron works for the bank, and as a bank employee, you get a slight discount to alone. So that's why he's so lucky. Okay.
Yeah.
Regarding monthly costs, were there any levies, rates, and taxes, things included?
So levies and rates was 1,000 rand.
1,000 rand. Okay, cool. Voids. So I saw based on the TPN report that it looks like a low risk area. So are you comfortable with a 5% void provision?
So I said 8% because I was struggling to tell what actually the risk is in the area. Because when I did call the agent here, he did say the current tenant's on notice for missing 1 month's payment. So I did put 8% just to be safe.
Okay, cool. Well, what you're seeing here on the screen, ladies and gentlemen, is the TPN report for this property that Tyron's looking at. What you can see here is a green, yellow, or green, orange, and dark orange field. So what you can see is Global Frontier is in the slightly yellow-orange field. Now, what that means is that the tenants paying on time is 5% below the national average. Tyron, I'm just going to quickly put you on mute here because there's a little bit of feedback. I will put you back on in a second. So here, this Blowboss Ranch here, that's the area he's looking at. You can see it's an orange field, which means the tenants are paying 5% less, or they are delinquent 5% of the time more than the national average. Now, the national average today is sitting at about 85%. So 5% less of that means that 80% of the time in the Blowboss Ranch area, you're getting paid on time. So I would then, using that assumption, use a void cost of about 12% because that's a medium risk area. Okay, so Tyron, I'm going to just bring you back on here. Management fee, are you going to manage it yourself or are you going to use a managing agent?
I said managing agent. So
Okay,
10%.
cool. Okay, I'm going to put 8% because this is including that here. And then maintenance provision, are you planning to put some money aside in case there's a management maintenance fee included?
Yes, I did. I think I said around 5%.
5%. Okay, fantastic. So let's just go here and we'll see that our cash flow is sitting at 1,137 Rand per month, which is pretty great. Now we can go to the summary tab. What the app does is the app then works out what the return on investment is. So for this specific deal, it's sitting at just under 19%, which is absolutely fantastic. The capital that you'll need to invest, Tyron, is 72,000 Rand.
Yeah.
Okay, so the last thing that I want to look at is I just want to look at the scenarios tab, which is telling us where the risk in this deal lies. Essentially, what this is telling you here is if things had to change, i.e., if let's say here, the rental income had to be different, it had to be higher or lower than what we expected, how would that influence the deal? So what you can see here is that when the rental income is on the original figure, you're getting about a 19% return. But if your rental is 20% less than you expected, your return is only sitting at 5%. So Tyron, my advice to you here, this is an amazing deal. It makes a lot of financial sense as long as you can verify that 5,500 is the income that you can achieve. If you can achieve it, you need to put an offer in for 260,000. This deal is great. I wouldn't think too much more of it. Looks good. Do you have any final comments that you want to
add? Nothing from my side. So
Okay.
get in contact with the estate agents and see if they would even take the offer price of 260.
Sorry, man, we're losing you a little bit. Okay. Sorry, Tyron, we're losing you there a little bit. But thanks for contributing. Thanks for being a part of it. And yeah, I'm sure we'll catch up. We'll catch up soon. But that deal does seem to make a lot of sense. So let's move on to our next deal that we're going to analyze together. And this one is Colleen. So Colleen, I'm just going to add you quickly to our call. Let me just find you over here. Add, and then you can tell us a little bit about the deal. So thanks to Tyron for that. I'm going to save this deal here, and we're going to add a new buy-to-let investment, which will be Colleen's student accommodation deal, which is quite exciting. So Colleen, are you online yet? Let's see. Okay, so this is the property that Colleen has asked me to do a quick look through. So we'll just have a look here. It's a 13-bedroom house for sale in Hurst Hill. Hurst Hill is in Johannesburg area within close distance to Wits, which is obviously important. You need a good location property. It looks like it's a main house with a few flats and cottages on the back, in the background. So let's have a look here to see how this one is going to work. Pauline, are you there?
I'm here, Lawrence.
Hi there. Yes, we can hear you. Tell us a little bit about this deal. How did you find it, and what are the basic numbers?
Okay, before we go ahead, we actually wanted to do the other one, the one that's actually the property in Edenvale.
Yes, is that the flip, hey?
Yes.
So sorry, Colleen, do you mind if I sit with you and Anithia afterwards and look at that deal? Just because the webinar today is focused on the cash flow, the rental strategy. I'm happy to sit with you guys privately and look at the flip deal, if that's okay.
Okay, thanks. Okay, so this deal here, the one in Hurst Hill, that was brought by an estate agent that actually does the area.
Yeah.
So the current owners of this property are actually a businessman. So apparently they don't have time now to carry on, looking after this property. So that's why they're selling. Yeah, but at the moment they're not looking for anything less than 1.8 mil, which we feel is still a bit high for
What's the asking price for this one?
This one is 1.9 million.
1.9, and you're saying they're only going to accept the 1.8 million rand offer.
That's right. Yeah.
Okay, well, let's run the
so
numbers.
With that,
yeah.
Okay, and then with that, they said because with NASFAS also coming into play with this property.
Yeah.
So you'd actually be getting, twice the amount afterwards.
Yeah. So my first bit of advice there, Colleen, is that whenever someone is being paid to sell you something, they're going to say whatever they can to try and get you across the line. So I know NASFAS very well, and I know that you don't necessarily get the best rates there. So let's run the numbers and see if financially this deal does make sense. So I see that you've got 16 beds here, or 16 students that are going to live here.
So it's 16 bedrooms, yes.
Okay, and NASFAS, you're getting about 3,250 per bed. Is that correct?
That's right.
Okay, so they're saying the rental that you could achieve here is 52,000.
Yes.
Okay, now we're going to go here to step 2, which is our buying costs. So we're going to go back to our Uber transfer calculator. Are you going to get a loan on this property, or are you going to pay cash?
No, that will be a loan. So that will be either with investors, so other people's money at the end of the day.
Okay, and you're looking at what, like a 90% loan?
That's right.
Okay, so let's go for a 90% loan. It's a freehold, no. And you're going to buy it in a company or in your personal name?
That will be in person.
Personal name. So your buying transfer costs will be about 100. Yeah.
Lawrence, before you carry on, so because I believe now if you buy it in a company, apparently there's all other, factors that's involved with that. So like your taxes.
No, it's more when you buy. If you're buying it from a company, you'll have to pay VAT. So if the seller that you're buying from is registered for VAT, you'll pay VAT, but then you won't pay transfer fees. So you're either going to pay transfer duties or you're going to pay value-added tax.
Okay.
So if you were to buy it in the company name, you see it doesn't actually change the transfer costs to you. But if you are buying from someone who's VAT registered, then if you recalculate, then it's going to be 65,000.
All right.
Okay, but
so in your opinion, to do something like this, what would be better, in a company or as a natural person?
I would always recommend buying in a company, just because there's limited liability. If you've got all your properties in your personal name and something goes wrong, they can attach all the properties in your name to the debt. And my rule of thumb is always purchase in a property in a company, and then have the shares of that company owned by a trust. That's the best way to protect your wealth.
Oh, okay.
Okay, so 105,000 Rand is your transfer costs. I've had a look here at the pictures. It looks like it's already in very good condition.
Yes.
I would say maybe 50,000 Rand in terms of renovation costs, just to touch up here and there. Okay, financing, we're going to look at hopefully a 90% loan. So if you're loaning in a company for student accommodation, you're probably going to get a worse interest rate, probably about 11.5.
Yeah.
Okay. Now let's go to the cash flow. This is where it gets interesting. Because it's a freestanding property, there won't be levies, but there will be rates and taxes. They should put it here, rates and taxes. Rates and taxes here are 555. Okay. Insurance, you're probably looking at about 450 insurance. Let me just see here. Why are they saying there's a 36,000 Rand gross rental income and we worked out 52,000?
That was when they were working on not having NSFAS at the moment.
Okay.
Yes.
Okay. Because 52,000 does seem a bit high for me. But anyway, let's see here. So void cost. Now, voids is the cost of the property being vacant. Now, the thing with NSFAS, especially with NSFAS, is you're only getting 10 months rent. You're not getting 12 months rent.
Yes.
So you've got a minimum of 16% void that you have to take into account. That's assuming that for 10 months you're going to be fully booked, which might not be the case. So are you comfortable with me working on a 20% vacancy, meaning that 20% of the time we're not going to have tenants to rent the property?
You can do that.
Okay, management fee, you're probably looking at least a 10% management fee. And then maintenance provision, I usually like to work on a 15% maintenance provision, meaning that 15% of the income you receive, you put away for a rainy day for when they need to replace the locks or the geyser or repaint or whatever it may be.
Yeah.
Okay, and then here by other, we're going to have to include a cost for water and electricity. Okay, so usually you're probably paying about 250, times 0. You're usually going to pay about 250 Rand per person per month for electricity, and probably about 300 Rand per person per month for water.
Okay.
We're going to then times that by 16. That's going to be our cost of water and electricity. Does that make sense?
Yeah.
So here our cash flow is minus 5,400. Does that make sense?
Yeah.
This
So
might be a
these
bit
are one of
high
those
though.
deals that you avoid. Yeah. I don't think so.
Oh, sorry, I must have made a mistake with my calculation because it's 250. Oh man, 250. Sorry, plus 300 is 550 times that by 16. Sure, I'm not doing this well today. Sorry, guys. 550 times 16 is 800. Oh, sorry, I must have doubled it then.
It's 8,800.
Okay, here we go. Cash flow is sitting at 3,338, which means your return on investment will be 12%. Okay. But you will need to put 335,000 of your own money into this deal.
Okay.
I don't know. Colleen, the two things that I don't like about this deal is one, 1.8 million for property in Hursthill is way too much.
That's right.
I don't think you're going to get 52,000 Rand rent because you've only got 13 bedrooms here. You don't have 16 bedrooms. So there's going to be students sharing, and sharing students aren't going to pay 3,250 for a shared room.
And who says that NSFAS is going to come to the party as well?
Yeah, I mean, they say that this is NSFAS registered, but you can see here that there's only 3 bathrooms.
Yes.
Now, one of NSFAS's accreditation protocol is that you have to have at least 1 bathroom for every 4 students. So if you've got 16 students, you already need 4 bathrooms.
Yeah.
And they've only got 3 bathrooms here. So I'm questioning whether this is already NSFAS accredited or not. And here, parking for 2 cars, you need to have at least 1 parking for every 3 students, I think. So again, the parking spaces isn't sufficient. So here they say it meets all the right criteria for NSFAS. I would want to see accreditation for NSFAS. I'd need to see a certificate. I'd need to see a sorry, let me just close my WhatsApp. I don't know why it's open. I'd need to see some sort of proof that I can get 52,000, and I'd only go in at about 1.6 maximum. Otherwise, you're paying too much for the property.
Yes. And that's why I thought it was actually even lower because I asked if we can go anything, between 1.3 and 1.4.
Yeah.
And then apparently the sellers were looking at nothing less than 1.8.
I'm going to use here 36,000 because this is what they said, that they are currently receiving 36,000. So I've just put that into the app. Let's go here to the cash flow now. You see cash flow is minus 4,000. That's what I think the actual value of this property is going to be. I think you're actually going to lose money on this property. The estate agent, I think she's telling you sweet little lies because I don't think you're going to get this deal across the line.
No,
that's
true, yeah.
I think if you can buy it at maybe because I was looking at Hurst Hill, I was looking at the 1.35 market. That's what I think is a good deal in Hurst Hill. Still not a great deal, but I mean, I wouldn't even go higher than that. I think you need to move to the next property, to be honest.
Yes, and also, in my opinion, with the amount of students that are there, and that place still needs to be spruced up to make it a little bit more livable than what it is now, because some of the furniture there is not conducive for students at the end of the day.
100%. 100%. Cool, Colleen. Thanks for joining us. I'm sorry that we can't look at the other deal right now, but I will schedule some time with you and Anithia just to discuss that deal in a bit more detail.
Okay, thanks so much.
Okay, I'm going to take you off. Thanks, hey. Okay, guys, we're going to do one more. Thomas over here, and then I also need to look at Sanjay's. So let me quickly invite Thomas on here. We are running a bit behind time, which is not great. I do want to get you guys out at 7. So let me just quickly try and invite Thomas here. And then Sanjay, if you don't mind, I'm going to just run the deal without bringing you online. And we can obviously also chat about it later on in private. Okay, so here's a deal from Thomas. He's saying there is a student accommodation deal in Nelspruit. Number of units 27. He thinks he can get 3,000 Rand per unit. It's asking, is that 16 million or 1.6 million? Probably 1.6 million. Or is that 16 million, Thomas? I think I've invited you. Let's see here. Thomas, are you able to connect? Let's just see here. Okay, so I'm going to start running the numbers of this one. So let's just go back here to buy to let, and let's just analyze a new deal. Okay, so we're going to analyze Thomas's deal. I think the asking price is probably 16 million based on the numbers that he's given me there. 16 million. So let's say we're going to offer maybe 15 million. He assumes that he can get 30,000 or 3,000 Rand per unit, and he can accommodate 15 students, 150 students, sorry. 150 times 3,000. He thinks he can get about 450,000 Rand per month. So let's have a look here. Okay. Our buying costs while I wait for him to join. Let's say he has 16 million. 15 million, and he's going to loan, let's say 13 million of that. It's a freehold, no, and he's going to buy it in a company. So his transfer cost is going to be 1.75 million. These are big numbers that we're working with. He stated that there are no renovations required, assuming a 90% loan to value. He'll probably have to get a commercial loan, which means a 13% over 15 years. Cash flow. Okay, so we're going to work on a 20% void, or let's work on 16% void. I'm sure the rates and taxes. Let's see if he gave me any information regarding rates and taxes. No rates and taxes, so I'm going to assume about 15,000 for rates and taxes. Insurance, another maybe about 5,000. Voids, management 10%, maintenance 10%, and then he's going to have to pay for the electricity and water. So let's work on 500 times 150. That's a 75,000 Rand cost in terms of water and electricity. So the cash flow on this deal will be about 15,000 Rand per month. Unfortunately, Thomas, I don't think it's going to be a good return. We're looking at about a 5.7% return, mostly because you're going to have to invest quite a lot of money yourself to do this deal just because of the size of it. You're going to have to put about 3.2 million Rand in. And yes, it's making positive cash flow from day one, but in my opinion, it's not making a lot of money. Maybe I'm being aggressive with my void costs. If we make the voids 10%, then the deal will be probably pretty good. Yeah, 15%. So I guess, and this is the tricky part, guys, is there are some assumptions you need to make. The assumptions are, how often is this property going to be empty? What are the maintenance costs going to be? These are sometimes things you don't know off the bat, and you'll have to make some sort of assumptions. So Thomas, in my opinion, I think if you can maybe buy this property at maybe 13.5 million rand, you can get the voids to 10% or less. Then you're looking at about a 23% return. Then I think it's a fantastic deal. It does look like you're struggling to connect here, so you are obviously welcome to come and meet me on Skype, and we can chat this more in detail. Yeah, but thanks for putting this forward as a recommendation. Last property that we're going to look at is Sanjay's property. So Sanjay is looking at a multi-let that is selling for 20 million excluding VAT. So I'm just going to say 20 million. 20 million. So let's just go here and we're going to add a new deal. Let me see if I can quickly add Sanjay to this. Sorry, guys, we're trying new things with our webinars. So sometimes it works, sometimes it doesn't. But thanks for being a part of it and being patient with us while we're trying this out. So he's looking at selling a friend of his property, and his friend wants, about 24 million rand for the property. So we're going to do a quick analysis to see if it's going to be financially feasible for an investor. So it's a AAA high-quality double-story office park. The rental income is sitting at about 187,000 per month. So let's put that in, 187,000 per month. Okay, we go back here to buying costs. Sanjay, are you expecting? There we go. Are you expecting to buy this property or sell this property to an investor who's going to get a loan?
I'm trying to sell the property to another investor, so I'm just acting on behalf of the seller. The price on the property is actually 20 million. Is what it's on the market for 25, and I've got a mandate to sell it for 20 million.
Okay. Cool. So let's go here to make it 20 million. And you said the rental is 187,000.
That's correct.
Is that on the low side? You can't make more than that, eh?
I actually think that the rental is a bit too low. He's renting out at about 84 rand a square meter, and the market, yeah, and it's AAA grade offices with air cons, and it's got generator on site around the entire property, fully, and it's very secure. The rental in the area. Sorry.
I think we could push the rental to 210. It sounds like it's a bit on the low side.
Yeah.
Okay. The investor that you're going to sell it to, they're probably going to get a loan, right?
Correct.
Let's say they're going to get an 80% loan because it's quite a big price, so they weren't going to get a 90%. So we're going to do this.
Commercially is 10 years as well.
Yes, true. Okay, so we're looking at about a 2.5 million for transfer fees. Refurbishments, do you expect or anticipate any refurbs on this one?
I wouldn't spend more than probably about 50,000. It's in good condition.
Okay, I'm going to then just leave that. So let's work on an 80% loan, probably a 13% interest rate over 10 years, because that's a commercial loan.
Sure.
Cash flow levies, are there any levies that you expect?
The levies, yes. Well, not really a levy, but the rates and taxes is 20,000 a month, including insurance.
Okay, brilliant. The levies, do you think we can push that onto the tenants?
Yes, the tenants pay all the levies. The body corporate covers all the other costs. So every single other cent is covered by the tenant and the body corporate.
Okay, your voids usually with commercials are quite low, hey, especially if there's long-standing tenants already in place.
Correct.
So I'm going to use 5% management. Maybe let's work with 5 and maintenance 5%. Now, okay. Immediately we're seeing here negative cash flow, and that's solely because the financing costs are so expensive.
Okay.
So if we can get a 15-year loan, maybe at a 12% interest rate, then it might work. Ooh, still not.
Yeah.
And also, sorry, I forgot to include, you're obviously getting paid a fee for selling this.
Yeah, well, I'm getting it'll be kind of a 4% com on it.
Yeah, so we're looking at another, couple of grand here, 300, 400 grand that you'd be getting here.
Yeah.
Sure. So, I mean, I think, as you can see here, the rental currently doesn't justify that purchase price.
Exactly.
What you'd need is you'd either need to reduce the offer price, or you need to bring this up to about 300,000. So if you can show that the deal makes 300,000 rand worth of rental, if I don't know if there's some sort of report or an estate agent that can show you a higher rental for that property, it's going to be very hard to get an investor to see the value in buying it at 20 million.
I agree. Yeah, I think the price definitely needs to drop. See, unfortunately, you can't just suddenly hike up the rental, because some of them are long-standing good
100%.
tenants, so you can't shock them with an increase. So it is starting off at quite a low base, and I think going forward, something to consider would be increasing the rental up front immediately
Yeah.
to make up for that loss.
Yeah, it's not gonna work. But let's just quickly look at the scenarios here, because we should be able to see if it's going to make sense. So you're gonna have to reduce the purchase price by 20% just to break even. So if we go back to our area analysis
Okay.
here, and we reduce it down to 16 million, which would obviously have a knock-on effect with your transfer fees, then we're looking at, on the current rental of 210,000, that's your break-even figure. So for an investor looking at this deal, they're going to want to buy it at less than 16 million just to break even.
And that's on 300,000 rental.
No, that's on the 200,000. So I went back, I
Oh,
reduced it back to 200,000.
okay.
So if you can get
Okay.
250,000 rental, which is a lot more achievable, then you start looking at a 9% investment.
Okay.
But either way,
Okay,
you
great.
hey?
That's it. Great. I think immediately you can show me that it's not a brilliant buy. So something needs to give in terms of pricing or rental income.
100%. What I'm going to do for you quickly here, Sanjay, is I'm just going to 30% LTV commercial loan. I'm just going to send you a quick proposal document.
Okay.
On the app, you can generate an investment proposal with a click of a button. I'm going to generate this proposal for you, which outlines all the finances. You can then take this to your investor or to the person selling the property and try and bring him down on price.
Yeah, no, I think I'm gonna contact the seller firstly and explain to him what's going on, and show him the numbers so that he can make a better informed decision in terms of reducing his price if he wants to sell it.
100%. You're gonna have to negotiate the seller down, because he's being a bit aggressive with his expectations. So I've sent you the report. You can take now the numbers to the seller and just say, unfortunately, the deal doesn't work at that rate.
Thank you very much. Much appreciated.
Cool, Sanjay. Thanks, man, and we'll catch up soon.
Great. Cheers.
Cheers. Okay, guys, that was intense. I really enjoyed that. I hope you guys did as well. I am going to end the webinar just with a quick explanation of the rent-to-rent model. Now, rent-to-rent is essentially a way in which you can get into the property market with zero capital. So here's one of my students, and he is buying a property, or he's doing a rent-to-rent in an area known as Kenilworth in Cape Town. So essentially what he's done is he's looked at this property. You can see an aerial view. It's currently an Airbnb / guest house property, which he is going to convert into student accommodation and then rent out to students. Okay, so this is what it looks like on the inside. You can see it's currently like, another 5 minutes. Currently in pretty good condition, being used as a guest house, and it can quite easily be converted to student accommodation. Actually, to be honest, it's pretty much already catered for students. If you look on the top right-hand side, you can see a photo of one of the beds with a TV and a little built-in kitchen. This is something that can be rented as is to students. So now what happens with the rent-to-rent model is, what my student's going to do is he's going to rent directly from the owner for a fee. He's then going to sublet the guest house to a number of students. Now, the fee that he sublets it for needs to be higher than the fee that he's letting for. So if he's letting, let's use the example, Colleen's example. Now, the deal that she's looking at doesn't work at the 1.8 million rand purchase price. What she could maybe do is she could maybe go to the owner and say, you know what, I'll rent this property from you for 20,000 rand per month. And then she can go and sublet that same property to 10 students at 3,000 rand each for 30,000 rand. So she's receiving 30,000 rand in, she's spending 20,000 rand, she's making a cash flow of 10,000 rand per month without having to purchase the property, no cost to renovate, nothing. It's a zero cash needed deal, and she's making a passive income. So just to show you the power of this, my current student, he's renting this out for 65,000 rand to, I think it's about 15 or 16 students he's renting it out to. He needs to pay the owner, so he's paying the rent to the owner of 30,000 rand. He's renting at 30,000, he's subletting at 65. It's a massive cha-ching. He also has to pay insurance, rates and taxes, water, electricity, Wi-Fi, and then some other provisions. He's walking away with a 12,000 rand cash flow without owning the property or without having to pay a single cent to buy it. So that, ladies and gentlemen, is just an example of how you can get into the property game without a serious amount of money. Right, running to the end of the webinar, I'm just going to now take a few minutes to answer some questions, and then we will be on our way. So we've got a question here from Zachariah. Hi, Lawrence. What is the benefit of having a trust hold the shares of the PTY? Okay, this looks like an interesting question. I just want to stop sharing my screen quickly. How do I do that? Okay, so the question is, what is the benefit in having a trust hold the shares of a PTY as opposed to using a PTY as a vehicle for holding the property? Okay, so essentially why I say you need to buy in a company is because you want to take away the liability from your personal name. Now, why you want to put it into a trust is because you've just added another layer of protection. When you're a director of a company, you can still be linked to your company's debt and to your company's issues. So let's say you register a brand new company today and you take that company to the bank to get a loan. The bank's not going to loan money to that company without you as the director taking personal surety of that loan. So you're going to loan R1 million through your company, but if your company defaults, they can still attach you, the director, and all of your personal assets to that company. If you've got a trust involved, however, the trust is a separate legal entity and thus you're more protected. So my advice to you is buy a property in a company name. Once you've got a portfolio, let's say 3 to 5 properties, put that company into a trust and then leave that trust on its own. Start a new company, buy new properties. Once you get to 5 again, put it into a trust, because a trust is very bad from a tax point of view. It's probably the most tax inefficient. It's very hard to manage. It costs about 10,000 rand per year just to manage, and then your taxes are on the highest tax level. It's not good from a tax point of view, but from a security and from a limited liability point of view, it is very, very good. That being said, I'm not an attorney. I'm not an accountant. Please send me an email. I'm just putting it here on the chat, my email address. Send me an email and I'm happy to introduce you to my accountant. He will give you maybe a bit more of a detailed reason as to why trusts and companies are good for investing in property. Hope that helps, Zachariah. Let's look here at Nyameka. Good evening. Is it always advisable to use other people's money to purchase a property instead of using your own money to get a good ROI? Great question. So it will definitely depend on a deal per deal basis. Sometimes when you're using your own money, you'll get a better return. But remember, using other people's money gives you more leverage. If you're only using your own money, you're going to run out of money at some point and you're going to stop buying properties. That's not the goal. You need to be leveraging other people's money to expand your portfolio. So my recommendation is use the app to work out what the numbers would be using your own money versus using other people's money. Whatever gives you the better return, obviously make that decision. But if you are struggling to expand your portfolio, get comfortable using other people's money. Because yes, you're 100% right. The interest rate on the payments is going to be a disadvantage. If you're looking at bank financing, which is probably the cheapest financing you're going to get, you're looking at 10% over 20 years. That's pretty good. If you start looking at private financing or commercial financing, that's when your interest rate goes from 10 to 15% over a 10 to 15 year period. That's when the deal starts to break down. So yeah, just Just make sure that the ROI makes sense for you, and using other people's money helps you leverage a bigger portfolio. And Yameka also asked, what type of taxes does a trust pay and what are the rates? So again, just send me an email. I'm happy to introduce you to my accountant. Otherwise, go and check out SARS's rates, SARS's website. So I'll just put here SARS trust rates. I'm going to share this link with you. This is a link where you can find everything you need to know in terms of what are the tax rates. If I'm not mistaken, I think companies are paying 28% tax. That I'm pretty confident with. I think trusts pay about 40 to 45%. So that's pretty much what you're looking at. So from a trust point of view, it's good for protection. It's very bad for monthly taxes. So guys, we're already past 7. I'm sorry for that. I usually like to keep these things under an hour, but we had a lot to discuss, a lot of things to go through. Thank you so much for being a part of this. We're going to be doing this every 2 weeks, and every 2 weeks we're going to bring 3 or 4 people on so that they can share their deal with us, and I'm going to coach everybody through their deal. So if you do want to get involved with sharing your deal, and you want to get me to just analyze and give my opinion on it, please send me an email and I will slot you in for the next webinar. Otherwise, a special thanks to Sanjay, Thomas, Colleen, and sure, I'm running a flat. Tyron, for bringing your deals and letting us, critique it online. I think everybody learned a valuable lesson from you. So thank you very much for your time. Thank you for being involved in this. I'm going to ask Apollo just to send this webinar as a recording to you tomorrow or on Friday or next week. And you can obviously check through anything that you might have missed. So guys, thank you very much. Until next time, happy investing. Nyamaka, thank you for being here. Keanu, thanks guys. It's been a great session. And yeah, until next time, happy investing.